Joseph Seydl, the EEM, which tracks emerging market stocks, is up around 18% so far this year. That's about triple the S&P 500. So do you think that emerging markets can extend those gains, or do you think that spread's going to narrow?
Well, first, that index for the past 5 years has been underperforming the S&P, so it makes sense for some catch-up. I think the overall index can probably continue to outperform the S&P, but that index is an agglomeration of many different trends within emerging markets. Many of them are commodity-driven emerging markets, like Brazil, South Africa, Russia, and they were dependent on the big commodity boom of the 2000s, which we don't think is going to repeat itself. When it comes to emerging market equities, we like Southeast Asia, India, Indonesia, even parts of China, like New China, which are uncorrelated to commodities. And we think they'll do very well in the coming years. But the overall index is still plagued by a lot of commodity exporters that we're not particularly excited about.
Can you just give me quickly your view as to what happens to emerging markets if and when the Fed raises rates? Because it's going to happen at some point. Could happen in December, even November. What happens to emerging markets?
You know, I think the big risk of a Fed hiking, much faster than what's priced in is kind of out off the table. Because recall at the start of the year, the Fed was looking at 4 rate hikes, and it moderated it down to 1 because of the dollar. And that impacted emerging markets significantly in January and February because we felt like the Fed was hiking too fast. Now the Fed's sort of optimizing at a very, very gradual pace. 1 rate hike this year, probably 2 at most next year. I think emerging markets can do fine in this slower rate hike path by the Fed.
All right, and what do those fine, or at least stabilized emerging markets mean for Europe? Because there's a lot of trade in between Europe and the emerging markets, probably more than between the US and the emerging markets.
Yeah, I mean, from a GDP perspective, Europe is 3 or 4 times more exposed to emerging markets than the US. The US is kind of like an island all on its own. It's really important for interest rates because the ECB eased in a big way earlier this year because of the slowdown in emerging markets and because of the pain in commodity prices. So to the extent that we're seeing stability in commodity prices and emerging markets starting to stabilize, it actually means Europe can start to outperform. And at the very least, it means ECB stops easing so that global interest rates stop falling, and it can allow sort of normalization within the equity market. Because the big distortion this year for equities has been the collapse in interest rates, and it's distorted the U.S. equity market, allowing utilities and bond proxies to outperform growth sectors. So finally, to the extent that the ECB is done easing, we can see more normalization in equities and allowing growth sectors rather than bond proxies to start to outperform.
All right, so what kind of returns can people expect from Europe? Because so far this year, European indexes are generally flat to down, and it was helped by Brexit this summer. Still hasn't come back all the way. So tell me your outlook for Europe in 2017.
Well, so Europe is becoming more and more a tale of many different stories. Economies like Italy are not adjusting at all. Italy has no nominal GDP growth. The banking sector is still plagued by very high non-performing loans. But on the other hand, countries like Ireland and Spain have made a lot of deleveraging progress, and they're starting to outperform. And of course, Germany is the leader in Europe. So it's a really fragmented story. The overall index is not going to do well because Italy and France and these sort of sluggish economies are still in there, but we like Germany still, and we like parts of Spain because Spain is finally adjusting. So to the extent that Europe can outperform the US, I think it's a very micro country dependent story. We don't think the overall headline is going to outperform the US because of the structural differences in countries like Italy.
All right, and then what about the US in 2017? What kind of return should people be looking for? And I guess the big question, especially regarding the election, is this all a Fed-induced bubble we're living in right here in the U.S.?
Right, so we think earnings next year are going to be 5 to 6% in the U.S. It's below consensus. We're looking at total returns of low, high single digits, 8, 9%, which is not outstanding, but it's still the leader when it comes to the developed market space on the broad index level. When it comes to interest rates and whether there's a bubble, as I said, the market was distorted by bond proxies. And the question of whether there's a bubble is a question of whether we're going to have a sharp increase in interest rates kind of popping the bubble. I don't think it's going to happen anytime soon because the Fed is in a very, very gradual spot. The ECB is done easing, but that doesn't mean the ECB is going to be tightening policy anytime soon. So global interest rates are going to remain very low, and it's going to allow multiples to remain high for a long time. High relative to history, but it's kind of the new normal within a low interest rate environment. We have to get used to a 17, 18 times multiple in the U.S. equity market.
All right, well, thanks a lot for coming and talking about it. Joe?
Thanks.
And thank you for watching The Street.